2024 is set to be a disappointing year for growth in major economies and maybe a perilous one for deeply indebted countries. Well, that's a very simple explanation of the World Bank's newest economic outlook, or at least one aspect of it. Ayhan Kose is Deputy Chief Economist of the World Bank Group, and he joins me now for more. Ayhan, thank you for joining us. Before we get into growth, I'd like to talk about inflation. And I wanted to ask, can we say that now the worst of this recent global inflation trend is over?
I think it's fair to say that the progress in terms of reducing inflation so far has been remarkable. So inflation has been coming down without a major financial crisis, without a significant slowdown in any of the large economies, despite record high interest rates. So inflation has peaked. The question is that will we see a slowdown continuing in the coming months? Our projections suggest by the end of this year, at the global level, we will see inflation coming down to 3%. But that number still, for many central banks, will be above their targets. So we are expecting interest rates, especially real interest rates, to be elevated for the foreseeable future.
What will that mean for normal households? Does that mean that prices will begin to fall, or that they'll stay high but that their wages will seem comparably well adjusted to it? Will mortgage rates stay difficult, I guess? How would you put it?
I think the big challenge is that, we saw price levels went up quite a bit. Now inflation is coming down, but it is not disinflation. It's not like prices are coming down. So consumers will feel these elevated prices, but at the same time, in many countries, we see wage inflation is faster than the the price inflation. That's good news. The purchasing power of consumers going up. On the mortgage rates and other interest rates we see in credit cards, we think that they will remain elevated for the foreseeable future. So we are not expecting interest rates to come down significantly unless we see sustained, persistent decline in inflation.
All right, so good news there if wages start to make up some of that gap with inflation. Now, your report also updates growth forecasts around the world. We want to take a look at a few of those numbers that stand out, both from developed economies and those that are emerging economies. Let's take a look here. We can see that India sticks out, for example, with 6.4% growth in 2024. This is a forecast continuing its trend of strong growth. China, meanwhile, expected at 4.5%, what might seem pretty good, but definitely slowing, coming down from over 5% in 2023. A big storyline there is it's slowing growth. The U.S. looking at 1.6% growth, which is actually better than expected, thanks to surprisingly resilient economic activity, while the Eurozone economy is expected to grow at a meager 0.7%. Now, again, these are often relative. You often can't compare these numbers directly to one another. What may seem like one high growth rate in one country is actually not that great for another. Anyways, let's go back to Ayhan Kose. He's Deputy Chief Economist of the World Bank Group. There are plenty of other countries that we didn't name here, and many of them are struggling with low growth and very high debt. You spend a lot of the report talking about those countries. Are we going to see more countries going into default in this coming year?
Now, when we think about debt challenges, those challenges, mainly we see in what we call frontier markets, economies. They have limited access to international financial markets and low-income countries. We have seen a number of them defaulting over the past 3 years. If growth remains weak and interest rates remain elevated, we might see more countries having debt difficulties. The important point is that it's going to be very difficult, if not impossible, for many of these economies to overcome the debt problem and make progress in terms of their development objectives. So the global community needs to find a way to address the debt challenges by, speeding up the resolution of debt problems in these economies.
You say in your report that there are a lot of downside risks right now. That means that things could get worse if certain crises spin out of control. Is it fair to say that for many of these countries, we're just one more big global crisis away from them going over the edge in terms of their ability to pay off these sizable amounts of debt?
Indeed, when you look the problems global economy is confronted by, those problems are taking place against the backdrop of multiple downside risks. One risk is heightened geopolitical tensions. We have the Russian invasion of Ukraine, and now we have a significant conflict in the Middle East. And of course, the tensions between large economies in the context of fragmentation. You have elevated debt levels and still high real interest rates. So you cannot, discount the possibility of financial stress. And of course, when we think about the climate-related challenges, the frequency and the cost of climate-related disasters have been increasing. So all in all, there are significant challenges down the road, despite the fact that global economy has been incredibly resilient so far.
I imagine this is also a pretty tough environment for funding climate measures.
It is a difficult environment, but the important point is that policymakers understand the need to ramp up investment. Policymakers see the importance to have green energy transition projects. And we see quite a pickup in the number of these projects around the world. The important and necessary step going forward, we need to ramp up investment and have sustained high investment rates, especially investment in green projects.
Okay, searching for investment, a big part of coming out of that low growth environment. Low growth is the order of the day, apparently, at least for 2024, at least for the forecast in your report, only slightly improving in 2025. We want to take a look at how difficult recent years have been in comparison to this latest interval. This is a look at 4-year intervals. It comes out of this World Bank report. Now, the World Bank expects that the first 4 years of this current decade will bring the weakest economic growth since the 90s. It's looking at 2% overall from 2020 to 2024. That's down from growth rates of about 3% and above for much of the past 30 years. Back to Ayhan Kose, Deputy Chief Economist of the World Bank Group. You talked about investment and the necessity of investment. Is this what we're seeing right now, this kind of low growth environment? Is this a series of events that we talked about? Pandemic, the war in Ukraine, potentially what's going on in the Middle East right now. Is it because of these kind of issues coming on top of each other, or are there broader structural challenges?
It's the combination of both. Of course, we have seen a barrage of shocks buffeting the global economy. And the outcome is that over the period 2020-24, we ended up with the weakest, the half-decade growth performance since the early 1990s for the global economy. Now, there is underlying slowdown. This year, we will see weaker growth in advanced economies, weaker growth in China, with repercussions for the rest of the world, given that, those are engines of the growth. The bigger problem around the world is how weak investment is and how weak trade growth is. So we need to see more private sector activity. We need to see pickup in investment as well as trade growth this year.
That's probably going to require interest rates coming back down. Is that ultimately what it comes down to?
It's a little bit of that, but at the same time, let's don't forget, many countries over the past 70 years were able to deliver sustained investment growth, sustained growth in trade. When we look at these countries and what they have done, they were able to put together a comprehensive package of policies, consolidation of fiscal balances, improvements in monetary, financial, and fiscal frameworks, improvements in institutions, and of course, improvements when it comes to private sector activity. Public sector can do certain things well, but it's necessary to bring the private sector, mobilize the private sector to accelerate investment growth, to accelerate energy transition.
All right, that's Ayhan Kose, Deputy Chief Economist of the World Bank Group. I want to thank him for this interview. And of course, we want to thank you, the viewer, for watching. There's plenty more here on our DW News channel on YouTube. Thank you.